All right, forget the intro. Let's get straight to it. Today we're cracking open a classic from the CMT Level 1 playbook,
Okay.
but we're doing it the Big Short Club way. We're talking about ATR, Average True Range. Now, Morgan, I see it on your charts, that squiggly line at the bottom. Tell me you actually know what it does,
Wait.
and you haven't just got it there to look clever.
Oi, have some respect. Of course I know what it is. It's the market's heartbeat monitor. Tells you if a stock is just chilling on the sofa,
Right.
or if it's running a full-on marathon. It's the hype meter, innit?
Hype meter? Not bad. I'll allow it. But let's get into the nuts and bolts for the people. What is it actually measuring? Because it's not just the high minus the low for the day. That's the kind of, basic mistake that gets you laughed out of the room.
Now, that's entry-level stuff. The real magic is in the T for true range. It takes the biggest of three numbers. First, you've got your standard daily range, the high minus the low.
Right.
Simple.
The one everyone knows. And the other two?
The other two are what make it smart. It measures the gap between today's high and yesterday's close.
Right.
And then it does the same for today's low and yesterday's close. It's all about the drama that happens when the market is shut. The overnight news, the weekend madness.
Exactly.
So if a stock closes at 100 pounds, but some wild earnings report drops and it opens at 120 the next morning,
Yeah.
a simple high-low calculation for that day completely misses that 20-pound gap. ATR sniffs it out. It finds the real range of motion. That's why it's the true range. It's the whole story, not just a chapter. Then the A for average just smooths out that truth over a set period, usually 14 days. So you get one clean number that tells you, on average, how much this thing is bouncing around.
So that's the what. Now the why. Why should anyone listening give a damn? I'll kick this off. Stop losses. This single idea is what separates the traders who last from,
Okay.
from the traders who end up telling bad beat stories down the pub.
Oh, here we go. Professor Chris is in the building. Skeptical. Let me guess you're about to tell me my old 2% stop-loss rule is for clowns?
It's not just for clowns, it's a one-way ticket to getting your account emptied. Applying a blanket 2% stop loss to every trade is like wearing the same size shoes for your whole life.
Right.
A 2% move in a sleepy utility stock is a monumental event. A 2% move in Tesla is just what happens before breakfast.
All right, you've got a point. One size doesn't fit all.
So how does ATR solve this? It's street smart. You look at the ATR value on your chart. Let's say the ATR for a stock is $5.
Okay.
If you put your stop loss just 2 away from where you bought in,
Yeah.
you're basically asking to be flicked out of the trade by normal everyday noise.
You're giving it no space to breathe. You're setting your own trap. You are. But with ATR, you can make an intelligent decision. You say, right, I'll set my stop at 2 times the ATR. So 2 times 5 gives you a $10 stop.
Ah.
Suddenly, your risk is based on the actual observed behavior of that specific stock, not some random number you read in a book. It's bespoke risk management.
That is genuinely useful. It's like tailoring the risk to fit the trade instead of forcing the trade to fit some rigid risk number. What's next?
Position sizing. This is the big one that separates the gamblers from the business-minded traders.
Right.
If your rule is to risk $500 per trade, you can't just buy the same number of shares every time. That's financial suicide.
Right.
Because a high ATR stock is more volatile, it moves more. Your $500 of risk could get triggered in a heartbeat if your position is too big.
Exactly.
So if a stock has a low ATR, say $1,
Okay.
you can afford to buy more shares. If it's a beast with a $10 ATR, you buy fewer shares. The ATR tells you how much firepower to bring to that specific battle. You don't bring a shotgun to a water pistol fight.
Okay. I'm with you. And there's one more thing, isn't there? The quiet before the chaos. The low ATR setup.
The squeeze, my absolute favorite. When you see that ATR line go dead flat, getting lower and lower for a week, that is the market coiling up like a python. It's getting tight, the range is compressing, that's pure stored energy.
And when it finally breaks out of that tight box,
Yeah.
the ATR is going to go vertical. That spike helps you confirm the move. It shouts, this is real. The game has changed. It helps you filter out the fake outs.
It's a regime change signal, from quiet to loud, from peace to war. That's your cue to pay attention. So it's not just a risk tool, it's a timing and conviction tool as well.
Okay. That's the theory. Let's get more practical. There are different ways to actually use this for stops, right? You've got your basic static stop, but what's this chandelier exit you were laughing about? Sounds a bit too fancy for us.
The chandelier exit, it sounds posh,
Yeah.
but it's brutally effective. It's a type of trailing stop.
A basic ATR stop is static. You set it, and it stays there. A trailing stop is your loyal mate that follows you. So as the price moves in your favor, your stop loss moves up with it, locking in your profits as you go. Precisely. But the chandelier is clever about how it trails. For a long trade, it finds the absolute highest price the stock has hit since you got in,
Right.
and it hangs the stop loss below that peak. The distance it hangs is, you guessed it, a multiple of the ATR, like 2x or 3x.
So it's literally hanging from the ceiling of the price chart like a chandelier from a roof. I get it. That's actually a brilliant name. So you're always protecting a good chunk of your open profits while still giving it room to run.
Exactly. It stops you from giving the whole move back when the trend eventually bends. It's the art of letting your winners run, but on a leash, a very smart volatility-adjusted leash.
So you have the basic stop, the trailing stop,
Yeah.
the fancy chandelier.
Yeah.
The core idea is to take the emotion out of the exit. The system is making the decision, not your sweaty palms while you're staring at your P&L balance. 100%.
Trading is a psychological game.
Oh yeah.
And tools like this enforce discipline. It transforms your exit strategy from a gut-wrenching guess into a cool, calm, mathematical process. No more, I'll just give it a little more room until half your account is gone.
Ruefully. We've all been there. Okay, so to sum it up, ATR gives you the true volatility, helps you set intelligent stops, guides your position size, and flags when a big move is coming. It's a proper Swiss Army knife for a trader.
It absolutely is. And for anyone studying for the CMT, this is your bread and butter. But you can't just memorize the formula. You have to understand the street-level application. That's the difference between passing an exam and actually making money.
Couldn't agree more. So, wrapping up for the listeners, ATR isn't a crystal ball telling you where the price is going.
No.
It's the weather forecast telling you how rough the journey is going to be.
Perfect summary. It's your volatility dashboard. Use it to decide your risk, your size, and when to brace for impact. And please, for the love of money, stop using a fixed 2% stop loss on everything. You're better than that.
All right. Message received, Gaffer. Before we sign off, don't forget everyone, get in the chat group. The link's down below. Hop in and have a laugh with us. We're in there all day talking trades, ripping into each other's bad calls, and sharing wins.
Do it. Now, as we leave you, here's a question for everyone to chew on for the week.
Let's have it.
We've talked about how a low ATR often comes before a massive breakout.
Right.
But how do you tell the difference between a stock that's just boring and dead, where the ATR is low and stays low, versus one that is genuinely coiling up for a huge explosive move? What are the other clues you'd look for? Have a think on that. We'll see you in the chat.